In the high-stakes world of Canadian business, prestige and celebrity is usually measured in headlines. You have the flashy tech CEOs giving TED Talks about the future of AI, the oil tycoons in Calgary negotiating billion-dollar pipeline deals, and you have the grocery barons like the Westons whose faces are plastered on every news channel whenever the price of bread goes up. But the most successful merchant in Canadian history is a man you've likely never heard of. He doesn't give interviews, doesn't go to glitzy charity galas, he doesn't even have a Twitter account. His name is Larry Rossi and is the architect of Dollarama. And if you think Dollarama is just a cheap store where you buy discount candy in plastic buckets, you're looking at the world through the wrong lens. Since it went public in 2009, Dollarama's stock has outperformed Apple and Amazon. It's left the big Canadian banks in the dust. It's a company that generates profit margins that would make a luxury fashion brand jealous, yet it sells items for less than the price of a latte. So, how'd they do it? How did a family-run variety store from Montreal manage to fight off the biggest American retailers on earth? How did they survive the retail apocalypse that destroyed Zellers, Sears, and Target? And how did they convince an entire nation that buying a $4 spatula was the ultimate act of financial prudence? The year was 1990, and Larry Rossi's family business was dying. The Rossi family were Canadian royalty in the merchant world, with roots stretching back to the days before the First World War. The dynasty began in 1910 on the cobblestone streets of Montreal. Salim Rossi, a Lebanese immigrant with a sharp eye for value, opened a general store called S. Rossi Inc. on Craig Street. He sold the essentials of life such as thread, tobacco, razor blades, and simple tools to the working class families of Quebec. For decades, the Rossi model worked. Under Salim's son, George Rossi, the business evolved into a chain of variety stores. These were the five and dimes modeled after the famous Woolworths in the United States. They were the neighborhood hubs where you bought a birthday card, a toy for your kid, and a pack of gum. But by the time Larry Rossi took the helm in 1973, the ground was shifting beneath their feet. The retail world was entering the era of the category killer. As Robert Spector wrote in his definitive history of the era, these new giants had one goal: to dominate a distinct classification of merchandise and wipe out the competition. If you wanted toys, you no longer went to the corner store, and instead you went to the massive Toys R Us that had just opened near the highway. If you wanted a hammer, you went to Home Depot, and looming on the horizon was the terrifying shadow of Walmart, which was preparing its invasion of Canada by swallowing up the old Woolco stores. S. Rossi Inc. was stuck. It had 44 stores, but they were too small to compete on price with the giants, and too generic to compete on quality with the boutiques. Larry Rossi knew that if he didn't pivot, the company his grandfather built would just be another footnote in the bankruptcy courts, right next to Eden's and Byway. He found his inspiration in the deep south of the United States. He'd been watching the explosion of a new retail concept called the deep discount dollar store. Chains like Dollar General were growing like wildfire by doing something radical. They stripped down retail to its absolute skeleton. They implemented no discounts or distribution of flyers, nothing that might add to cost, just one price. Larry wondered if he could transplant this model to the frozen north. His advisors told him he was insane. They listed the reasons why it would fail. First, the exchange rate was brutal. The Canadian dollar was weak, making imports expensive. Second, operating costs in Canada were significantly higher than in Alabama or Mississippi, thanks to higher minimum wages and strict labeling laws. And third, they argued that Canadians were too snobby. The conventional wisdom was that Canadians were conservative shoppers who valued brand names and would look down on a store that sold everything for a loonie. Larry Rossi ignored them all. In April 1992, he picked a location far away from the prying eyes of the Montreal business press and chose a small S. Rossi store in Matane, Quebec, a quiet town on the Gaspé Peninsula. He closed the doors, gutted the interior, and removed every single item that cost more than $1. When he unlocked the doors, he didn't know if anybody would show up, but within hours, the store was in chaos as customers cleared entire shelves into their carts, treating the merchandise like it was free. Inventory projected to last a month disappeared in days. Larry Rossi realized he'd unlocked a powerful psychological trigger. The $1 price point acted as a total sedative for financial anxiety. A $10 item forces a customer to pause, evaluate the cost, and hesitate. A $1 item bypasses that logic entirely. Rossi acted with urgency, dismantling his family's 80-year legacy to fuel the new venture. He converted the entire chain into the Dollarama format, effectively pivoting the whole company toward the discount model. By the early 2000s, the S. Rossi name was replaced by a dominant new concept. By 2004, Dollarama was the undisputed king of the discount sector in Eastern Canada. They had successfully grown to 300 stores and were generating cash with incredible efficiency. But Larry Rossi had hit an invisible wall. He wanted to conquer Western Canada, a vast region where Dollarama was virtually unknown and where local competitors were digging in. However, the infrastructure required to manage a national empire is vastly different from running a regional chain. The Rossi family had reached the absolute limit of what a private, family-run management team could handle. Larry Rossi needed not just money, but a partner who understood how to build a global corporation. Enter Bain Capital. For those who follow the darker side of Wall Street, the name Bain Capital often carries a terrifying weight. Based in Boston and famously founded by Mitt Romney, Bain is one of the world's most aggressive private equity firms. Firms like Bain are viewed as corporate raiders, with their standard playbook, known as the leveraged buyout, involving the purchase of a healthy company, loading it with billions of dollars in debt to pay for the acquisition, stripping out the valuable assets, and slashing the workforce to boost short-term profits. So, when the news broke in November 2004 that Bain Capital was buying 80% of Dollarama for roughly $1 billion, the Canadian business establishment braced for impact. Financial analysts predicted that the American sharks had arrived to strip the copper wiring out of the walls. There was a widespread fear that the unique culture Larry Rossi had built would be crushed under the boot of American corporate efficiency. Critics warned that Bain would force Larry out, cheapen the products, raise prices, and eventually sell the scraps. But surprisingly, this story isn't like that. In fact, it showed everyone how private equity is supposed to work. Bain Capital's team flew to Montreal, opened the books, and realized that Dollarama wasn't a distressed asset that needed fixing. The profit margins were higher than luxury retailers, customer loyalty was cult-like, and the supply chain Larry had built in China was bulletproof. Bain sat down with Larry Rossi and offered a deal. Recognizing that the Rossi family's merchandising genius was the company's greatest asset, they insisted Larry remain CEO and positioned themselves strictly as the builders of the corporate engine, leaving the retail strategy entirely in the hands of the founder. True to their word, Bain kept the entire senior management team in place, and they opened the checkbook to fund a massive technological overhaul. Bain provided the one crucial element the Rossi family lacked: sophisticated data analytics. Before Bain, Dollarama opened stores based largely on Larry's gut instinct. He would drive around a neighborhood, look at the foot traffic, and decide if it felt right. Bain replaced that intuition with algorithms. They brought in teams of geographers and data scientists to map out the entire Canadian retail landscape. They analyzed demographic data to identify Dollarama's sweet spot, and they looked for specific intersections with high density, specific income levels, and proximity to other anchor stores like grocery chains. This data allowed them to pinpoint hundreds of new locations with surgical precision, minimizing the risk of a new store failing. Armed with this digital roadmap and a restructured debt load, Bain secured the capital necessary to launch a massive offensive. They rapidly expanded the chain into Western Canada, opening dozens of stores across Alberta and British Columbia. This overwhelming speed suffocated local rivals like everything for $1 before they could even mount a defense. The climax of this partnership arrived in 2009. The global economy was just beginning to crawl out of the wreckage of the 2008 financial crisis. Investors were terrified and the market was volatile. Yet Bain decided it was time to take Dollarama public on the Toronto Stock Exchange. It was one of the most successful IPOs in Canadian history. The timing was impeccable. Investors immediately identified Dollarama as a rare, recession-proof asset capable of winning in any climate. Whether the economy is booming with party supply sales or crashing with demand for canned goods, the register keeps ringing. This versatility drove the stock price sky high, instantly cementing Dollarama as a powerhouse on the TSX. When Bain Capital finally exited the investment, they walked away with billions in profit and a massive success story. Despite the influx of billions from Bain Capital and a successful IPO, Dollarama entered the post-2008 world facing a crisis. The everything for $1 model is incredibly susceptible to inflation. Inflation is the natural predator of the fixed-priced retailer. Every year, the cost of doing business creeps upward, and when inflation hits a standard retailer like Walmart, their solution is just to update the sticker. A 50-cent hike barely registers with the average shopper. But Dollarama faced a much harder reality. Because the company's identity was anchored to a specific coin, Rossi had zero room to maneuver. Every time his costs ticked up, he had to eat the loss, knowing that raising the price risked destroying the brand's core promise. Larry Rossi stared at the numbers and realized he was trapped. If he maintained the $1 cap, he would eventually be forced to compromise on the product itself. The chocolate bars would have to shrink until they were bite-sized, the aluminium foil would have to become so thin it tore when you looked at it, and the laundry baskets would become brittle and crack after one use. He understood that heading down the path of shrinkflation was a suicide mission. The alternative, however, was equally terrifying. Raising the price meant risking the company's identity. The fear was that the moment a customer saw a price tag for $2, the spell would break. They would look at the sign that said Dollarama and feel lied to. In early 2009, Larry Rossi tried testing the waters. He quietly introduced items priced at $1.25, $1.50, and $2. The executives expected the worst, but the customers didn't care. They saw a full-sized bottle of bleach for $2 and grabbed it. The logic was simple. Why pay $5 at a supermarket when you can pay $2 here? The deal was still undeniable. The experiment proved that as long as the deal remained undeniable, the price point was negotiable. This realization was the Rubicon moment for the corporation. By shattering the $1 ceiling, Dollarama unlocked a massive new universe of inventory. Suddenly, the buying team could look at products they had previously ignored. The store started stocking legitimate hardware tools that could actually drive a screw without stripping. They introduced glassware and ceramic plates that had weight and durability and brought in brand name confectionery giants like Mars, Hershey's, and Coke, selling the real thing rather than generic knockoffs, and they even expanded into electronics, offering HDMI cables and smartphone chargers that functioned perfectly but cost a fraction of the price charged by big box electronics stores. This multi-price strategy became the ultimate weapon in the coming war against American invaders. In 2010, the US giant Dollar Tree launched its invasion of Canada, acquiring a local chain and announcing plans to conquer the market. Dollar Tree entered the arena with a rigid, dogmatic adherence to the everything for $1.25 model. They believed that the purity of the price point was their greatest strength. In reality, though, it became their fatal weakness. When the two chains went head-to-head, Dollarama slaughtered the competition. Because Dollar Tree was handcuffed to the $1.25 cap, they were physically unable to stock the higher quality items. They couldn't sell the $5 yoga mats, the heavy fleece blankets, or the decorative pillows. Dollarama simply out-merchandised them. Their stores felt fuller and the products felt more substantial. The shopping experience didn't make you feel like you were at a discount store. Today, Dollar Tree remains a minor player in the Canadian market, restricted to a lower income demographic and surviving on razor-thin margins. Dollarama, meanwhile, secured a market share hovering around 50%, effectively becoming the Amazon of the physical world for millions of Canadians. With the global supply chain secured and the multi-price strategy successfully implemented, the Rossi family had built a formidable engine. However, the final component of their dominance lies in something far more abstract than logistics or finance. It resides in the subconscious mind of the consumer. This is the domain of Neil Rossi, who took over the CEO role in 2016 and refined the in-store experience into a masterclass of behavioral psychology known as the treasure hunt. Shopping at a traditional grocery store or a big box retailer is often a chore driven by necessity. You enter with a mental checklist and you navigate the aisles with efficiency, eager to complete the task and leave. It's a purely transactional experience. Dollarama, conversely, is designed to be experiential. The store layout is a carefully engineered dopamine trap intended to disrupt your discipline and encourage impulse buying. The manipulation begins the moment you step through the automatic doors. You're rarely funneled directly into the aisles containing toothpaste or school supplies. Instead, the prime real estate at the front of the store is dedicated entirely to seasonal rotation. This constantly shifting inventory creates a powerful sense of scarcity. Unlike the toothpaste, which will always be there, the seasonal item represents a fleeting opportunity. This triggers a mild fear of missing out response, prompting the customer to place the item in their cart immediately, bypassing the logical part of the brain that questions whether they actually need a ceramic pumpkin. The shopper is then guided into the general merchandise aisles where the true treasure hunt begins. This strategy relies on the unpredictability of the stock. Nestled among the generic kitchen gadgets and plastic storage bins, a customer might stumble upon a brand name shampoo, a package of high-end socks, or a licensed toy that would cost 3 times as much at a department store. These items are often grey market goods, which are overstock brought from other retailers or products with packaging errors. But to the consumer, they feel like they're getting a steal. Finding a $12 item selling for $4 releases a hit of dopamine, creating a sensation of winning against the system. This psychological reward lowers the shopper's financial defenses, and once a customer feels they've saved money on a treasure, they become significantly more likely to splurge on other items. By the time they reach the back of the store to pick up the roll of tape they originally came for, their basket is often filled with $20 worth of items because they had no intention of buying when they left their house. This reliance on the physical, sensory experience of the treasure hunt explains Dollarama's stubborn refusal to embrace the digital age. In an era where every major retailer has poured billions into e-commerce infrastructure, Dollarama has steadfastly declined to sell individual items online. And it makes sense too from a logistical perspective. The margins on a $4 spatula are simply too thin to support the costs of picking, packing, and shipping it to a customer's doorstep. But more importantly, the Rossi family understands that you cannot digitize the impulse buy. A customer sitting on their couch is rational and only buys what they need. A customer standing in a physical aisle, surrounded by cheap, colorful goods, is emotional. Dollarama needs you in the building to make the math work. The ascent of Dollarama from a single store in a Quebec mill town to a national empire is a reflection of the changing economic reality of Canada itself. The Rossi family bet their legacy on a somewhat grim prediction that life was going to get more expensive. Unfortunately for regular people, but fortunately for their shareholders, they were correct. Dollarama offers a strange form of psychological relief. It remains one of the few places left in the modern economy where a $20 bill still commands respect. It allows a teacher, a construction worker, or a student to walk into a store and fill a basket without anxiety. Dollarama succeeds because it admits the quiet truth that we're all looking for a way to maintain our standard of living in a world that keeps getting more expensive. As long as that economic pressure exists, the green light in the strip mall will keep humming. The Rossi family figured out the code long before the rest of us realized the game had changed. But what do you think? Is Dollarama the hero of Canadian retail for keeping prices low, or is their dominance a symptom of a deeper economic problem? Do you miss the $5 items, or do you miss the days when a loonie actually bought you something? Let us know your thoughts in the comment section below, and thank you guys so much for watching, and stay curious.